Good afternoon. Thank you all for being here. My name is Andrew Eastman. I'm a partner in Husch Blackwell's Energy and Natural Resources Group. I represent clients throughout all stages of renewable energy project development. These days, that means a lot of work having to do with generating and monetizing renewable energy tax credits. Before we begin, let me cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions, please submit those via the question box. We'll try our best to answer all questions during the presentation today, but if we run out of time or if a fuller answer is needed, we'll be happy to get back to you by email. A PDF of our presentation is going to be available in the program materials folder. And toward the end of the program, please be sure to complete our short survey. We use your feedback to plan future programs relevant to your business needs. That's all for housekeeping items. With that, let's get started with our program. Presenting with me today are Doug Jones with Husch Blackwell, along with Kenny Hallisey and Dan Posnack with IMA Financial Group. Doug is a partner in our Energy and Natural Resources Group. His experience in tax law includes practical strategies for clients regarding mergers, acquisitions, joint ventures, workouts, both in and out of bankruptcy, recapitalization, divestitures, spin-offs, entity formation, as well as all forms of capital raising activities. He assists corporations, partnerships, LLCs, and other entities ranging in size from startups to multinational public corporations. Kenny Hallisey is a Senior Vice President with IMA Financial Group. He specializes in complex property and real estate in the renewable energy industry. Kenny's been an employee owner at IMA for 9 years. He helps lead the renewable strategy and growth for IMA across the country. Prior to joining IMA, Kenny spent the first part of his career working for two large EPC firms, Kiewit and Enerfab. He held a variety of roles there having to do with finance, risk, and business development. Kenny's also a veteran and former captain of the U.S. Army Reserve National Guard. Kenny earned his bachelor's degree at Pittsburgh State University, where he played football and was an ROTC graduate. He later earned his MBA from Georgia Southern University. Dan Posnack is a transactional liability leader at IMA Financial Group. Dan brings 20 years of insurance experience to his role managing IMA's transactional liability practice, where his areas of focus include reps and warranties insurance, tax liability insurance, and loss mitigation insurance. Prior to IMA, Dan spent about 10 plus years of his career underwriting and managing public D&O and blended management liability insurance products for private equity firms and asset managers. He also managed Zurich North America's transactional liability portfolio. Bolstered by his legal claims background, Dan brings a balanced perspective and understanding to meet the needs of IMA clients. Dan earned a bachelor's degree from the Manhattanville College and a Juris Doctorate from Pace University School of Law. With that, let me hand things over to Kenny.
Yeah, thanks, Andrew. I'll be real brief here, but a little bit under the radar. IMA is now one of the largest insurance brokers in the country, approaching $1 billion in revenue. The whole reason I'm here is we're an employee-owned firm, which I take great pride in. But our renewable portfolio and why we were invited to this is quite sizable. We have about $20 billion in assets that we insure across the country. We are the only insurance broker that actually has a department dedicated to renewable fuels. And then we build some really unique products in the space around performance guarantees and off-take and feedstock wraps in this industry as well. But Dan Posnack will have the lion's share of this from the insurance standpoint. And as you said, he leads our tax liability practice there out of New York City. So thanks a lot.
Thanks, Kenny. Let me sort of set the stage by giving the quick elevator pitch, Renewable Energy Tax Credits 101. The idea is that renewable energy projects out there, post-Inflation Reduction Act, have this capability, either a new capability or an expanded capability to generate tax credits. Those credits can be transferred to third parties. They're typically transferred at a discount. They go for, say, 80 to 96 cents on the dollar. And the buyers of those credits can use those to offset their own tax liability. So sellers are willing to do this, those who generate and sell the credits, because they've got credits, but they don't have an internal appetite for them. They've got insufficient tax liability. They just don't need the credits. What they need is cash on hand. And so a direct transfer sale lets them monetize those credits in a relatively streamlined and quick way. Sellers tend to include renewable energy project companies, manufacturers of energy components, and utilities, the ones who are making the credits. Buyers really are technology and industry agnostic. They tend to be any buyer looking to offset its own tax liability. With that in mind, let's dive into some of the more common types of credits that are out there so we can understand these before we get into talking about the aspects of these credit transactions. The one most people are likely most familiar with and that makes up a lot of these transfer deals is the Section 48 Investment Tax Credit, or ITC. This is a one-time credit. It's determined when the project that gives rise to the credit is placed in service, and it's valued as a percentage of the investment in the qualifying property of that project. So the project is going to have certain eligible costs, and the money that's spent on those costs becomes the eligible basis. And then this 48 ITC is a percent of that eligible basis. It starts out being 6%. That can increase as much as 30% if the project hits prevailing wage and apprenticeship requirements. There are some additional credit adders that apply as well that can get this credit as high as 40% or even 50%. The 48 ITC does come with recapture risk. Recapture risk means that this is subject to a tax authority one day deciding or finding upon audit that for whatever reason, this credit should be disallowed, this credit should be forfeit, it should be recaptured. Not all credits have that risk, but the 48 ITC does. The technologies that generate a 48 ITC credit include solar water heat, solar space heat, geothermal projects, MSW, municipal solid waste projects. Those are going to be typically landfill energy projects. Combined heat and power projects, wind, offshore wind, biogas, interconnection property, and some other types of projects as well. The Section 45 Production Credit, or PTC, is another credit. This one, though, instead of being based on the eligible cost spent on a project, is based on the amount of energy or the amount of components that a project puts out. And so the rates for the PTC, the Section 45 PTC, are going to vary depending on what's being produced. Those rates, whatever they are, though, are also subject to being increased if prevailing wage and apprenticeship requirements are met. Unlike the ITC, the PTC does not have a recapture risk. That means when you get into a transfer deal, the PTC likely is going to command premium pricing over an ITC because it's a safer investment. It doesn't come with that possible recapture risk. Solar, thermal, electric products are going to make this wind, biomass, hydroelectric, MSW, municipal solid waste, which is landfill gas projects, offshore wind, hydroelectric, and solar voltaic, which is solar energy projects. The Section 48E credit is another ITC and another investment tax credit. This one, however, is technology neutral, but the project, regardless of what sort of technology is used, does have to produce clean electricity to qualify for this credit. Clean electricity means that the project generating that electricity that qualifies for this credit has got to have a greenhouse gas emissions rate not greater than 0. It's also got to be a project placed in service after 2024. Like Section 48 ITC, the base rate here is going to start at 6%. It's going to go up as high as 30% if prevailing wage and apprenticeship requirements are met. Again, there are certain additional credit adders that can get up to 40 or perhaps 50% here. And like a 48 ITC, the 48E ITC is also subject to recapture. It applies to projects placed in service after January 1, 2025. It's going to phase out by 2035. The Section 45Y credit is another PTC, a production tax credit, but this one technology neutral. The technology is irrelevant so long as what the project does is produce clean electricity. And again, that's going to be electricity that has a greenhouse gas emission rate not greater than 0. And these as well have got to be placed in service after 2024. This has got a base rate that's set annually. It's got a floating base rate, but there is a 5x increase again for prevailing wage and apprenticeship. those additional credit adders apply if the project qualifies. And like the other PTC, there is no recapture risk. And so again, the 45Y is going to command some pricing premium in a transfer deal because it doesn't carry that risk. These projects are going to start in January 1, 2025. They're going to get phased out in 2035, a couple years after the technology neutral ITC. 45X is another PTC, a production tax credit, but instead of having to do with the type or amount of energy produced by a project, 45X has to do with energy components that are produced. It's a manufacturing production tax credit based on components manufactured. So certain components that are used in solar, wind, inverter, battery storage projects, those are the things that are going to qualify for this production tax credit. And the components have got to be produced in the US or in its territories. 45Q is a little bit different because it doesn't have to do necessarily with energy produced or with products produced. Instead, it has to do with carbon dioxide captured and sequestered or used. This is a credit that predated the Inflation Reduction Act, but it was certainly expanded by the Inflation Reduction Act and made more valuable. And it's based on the number of metric tons of carbon dioxide captured. The rate depends on how, the rate being what the credit is worth, depends on how that carbon that's captured is used or stored. It can either be stored, sequestered, or it can be used. Depending on whether you use or sequester, you're going to get a different rate. Regardless, there are prevailing wage and apprenticeship requirements in the related adder. 45Q projects have got to begin construction before January 1 of 2033, and 45Q does have its own recapture risk. 45Z is another clean fuel PTC, a production tax credit. It has to do with the production of clean fuels that are used for transportation. So this is a credit available with respect to any fuel produced in the US by a registered producer. You've got to be part of a registered program. And the fuel that you make has got to be usable either in a highway vehicle or an aircraft. And it's got to meet certain emission standards and other criteria. The fuel has got to be produced after December 31 of 2024. And it's got to be sold to an unrelated party sometime before or on December 31 of 2027. So these things have got to be produced by a registered facility, but they've also got to be produced, or rather they've also, they arise from fuel produced at what's called a qualified facility. And a qualified facility is one that's not claimed a number of credits in the prior year. This is another credit to which prevailing wage and apprenticeship requirements apply and provide for a possible adder. 45V is a PTC that specifically has to do with clean hydrogen. The rate of it, the value of the credit, depends on the greenhouse gas emissions that result from the production of the hydrogen. The more gas, the more emissions produced during the production process, the less valuable this credit's going to be. It's available for clean hydrogen that's produced after December 31, 2022. But that hydrogen has got to have been produced by a facility that begins construction before 2033. So there's eventually a 2033 sunset to get these plants built. Prevailing wage and apprenticeship, PWA, requirements do apply. And 45B is one of the few credits that qualifies for direct pay, or at least qualifies for direct pay for a private entity. Meaning instead of generating the credit and having to turn it into cash by selling it at a discount to a third party, a party generating, or rather a taxpayer generating a 45B hydrogen PTC is able simply to claim that as a payment of taxes on its refund. Come tax time, the government is going to look at that and see that payment of taxes equates to an overpayment of taxes. And just like any time where you've made an overpayment of taxes, the government will issue to you a refund. That refund is what's called the direct pay. It's a great option because you don't lose any value on the credit by selling it at a discount to a third party. But like a lot of government payments and refunds, the big question mark is, when is the government going to send you that check? Let me stop there and turn it over to Doug to talk about prevailing wage and apprenticeship and get a little deeper on some of these things that I've mentioned.
Well, thank you, Andrew. Good afternoon, everyone. Thank you for joining us. So digging into the prevailing wage and apprenticeship requirement. As Andrew was going over, the base rate for a lot of these credits, or for the ITC anyway, as an example, is 6%. And again, if you meet the prevailing wage and apprenticeship requirements, you get a 5x multiplier of that. So that same 5x multiplier applies to the PTCs under 45 and 45Y, and it applies to other credits as well. So it's a very important requirement, and one that most deals will treat as, not an optional thing, but something that must be obtained. Now, there are exceptions or exemptions for projects that do not need to meet the prevailing wage and apprenticeship requirements. One of them is for projects that have begun construction prior to January 29 of 2023. Beginning of construction is a term of art in this area of the tax law. It has been developed through a series of notices and other guidance published by the IRS. And essentially, there's two ways you can do it. You can begin physical work on a project of a significant nature. So you can dig a foundation, you can have a piece of custom machinery or equipment created where a piece of metal is bent or some wires are cut or something like that. And if there is physical in the real work done and it's of a significant nature, that's when you begin construction. Then there is also a safe harbor test, which looks at when the point of time at which 5% of the project cost was paid if you are a cash basis taxpayer, or incurred if you are an accrual basis taxpayer. That's a safe harbor, so it's very nice, and it doesn't require digging into the facts and circumstances. But in the marketplace, physical work test is used often, and it is one that is not, even though it is a facts and circumstances test and not a safe harbor, that people have gotten comfortable substantiating with things like photographic evidence of the day they dug the foundation or the day they bent the piece of metal. So both are good options. And if you are in an industry where one of the credits is about to expire, unless you begin construction of 2024, you're likely very well aware of these requirements. Once you begin construction, by the way, there is a requirement that you continue construction. So you can't dig a foundation and then shelve the project for 6 years and then pick it up again and say, oh, I began construction 6 years ago. You have to show continuous efforts or continuous construction. One way to do this is with the facts and circumstances test. Another way is with the safe harbor, where if you place your project in service 4 years after when you begin construction, you're deemed to have continuous construction. So that's one way to get around the prevailing wage and apprenticeship requirements. You can also get around them if you have a project that's 1 megawatt or less, sort of overall capacity. And if you're not in one of those two categories, then you have to worry about, well, how are we going to satisfy these requirements? So prevailing wage and apprenticeship requirements are two requirements or sets of requirements. There's prevailing wage and there's apprenticeship. All of this, by the way, backing up a second, comes from a law that's been around for a while called the Davis-Bacon Act, which was originally enacted to impose, basically for people who were engaging in projects with the federal government, entering into federal contracts, and they were required to pay their workers a certain amount and to utilize apprentices. This same concept was incorporated into the IRA, and that's why we now have these requirements. So the prevailing wage requirements, what is a prevailing wage? It's what the Department of Labor says it is. They look at various regions of the country, and they look at various types of jobs, be it an equipment operator, a welder, what have you. And for each of those labor categories in each of these areas, they tell you what the prevailing wage is. And if you pay that amount or more, you've met the requirements. The apprenticeship requirements are a little trickier. First, you've got to find apprentices that are in a registered program. So states, localities, other sort of governmental units have apprenticeship programs all over the country, and you can apply to them and have apprentices brought on board. A lot of times, union contractors will sort of have these requirements built into the way they do things anyway, but you can do it with a non-union contractor as well. And there are essentially a couple of requirements. You have to look at the total number of labor hours of a project, and a certain percentage of those labor hours need to be performed by apprentices. And then if you employ a certain number of people, you have to have at least one apprentice employed as well. And then if you're getting your apprentices from one of these registered programs, that registered program may have its own rules about ratios between journeymen and apprentices, and you have to follow those rules as well. So those are the requirements. There are ways to cure deficiencies, where if you discover you didn't pay prevailing wages or you didn't use enough apprentices, you can cure it. You can pay a penalty. And there are even exceptions to the apprenticeship requirement, where if you make a good faith effort to find apprentices and you are unable to, you can be exempted from those requirements. So that prevailing wage and apprenticeship is the largest credit adder. It's a 5X adder. There are others that are a little smaller. The first being the domestic content adder. This is an additional 10%. So if you're in an ITC, you go from 30% to 40, where if you have the right amount of steel and iron and manufactured components produced in the United States, incorporated into your project, then you meet the requirement. So 100% of the structural steel and iron must be domestically produced, and 40% of the manufactured products must be domestically produced. Certain industries have lucked into a safe harbor that has been issued for them with respect to the manufactured components part of this test. Before the safe harbor was issued, you had to go to your vendor and ask them, that widget you sold me, I need to know your cost to produce it, and I need to know where the widget was when you did the work that related to the cost, in order to figure out if it's domestically produced. That's a headache. Vendors don't like to give that information. It's hard to track, and it was definitely a roadblock. The safe harbor, what it does, it says, okay, if you're in the solar industry or the wind industry, for example, and if you're doing a solar deal and you buy panels that are domestically produced, we will give you an amount of cost to assume is produced in the United States. You don't have to go get that information from your vendor. You can just use these US produced panels and assume that a certain amount of cost comes from domestic production. So it makes it a little bit easier to obtain, although a lot of people still run into difficulties tracking down that much domestically produced steel and iron. Energy communities is another bonus. So there are 3 different ways to be considered to be in an energy community and therefore eligible for an additional 10%. So if you're in an ITC at 30%, then you get energy communities, you get up to 40%. These stack, by the way, so if you have domestic content as well, you can get up to 50. And then there's another one, which we'll talk about in a second. But there's 3 categories for energy community. The first is if you're on a brownfield site. And the only way to figure this out is you do an environmental study and you find sources of contamination that are on the property, on the site that you're doing the project. The other 2 are a little bit easier. The other 2 are areas that have had historical levels of coal or oil and gas activity and a certain amount of unemployment in the area. So if you're in an area with lots of oil activity and unemployment is of a certain level, then you're in one of these areas and you can qualify for an energy community. Same thing if you're in an area where a coal-fired power plant was recently retired or a coal mine was recently closed. If you're in one of these areas, you can be in an energy community. And luckily, or happily, there is a map that you can find online with a quick Google search, which will tell you which census tracts are in these areas, and you can pretty quickly determine whether or not you're in an energy community. Now we'll talk about the meat of it, which is section 6418, the section of the Internal Revenue Code, which allows for transfers of tax credits, allows people to monetize tax credits if they don't have the tax liability to use them. Prior to 6418, there was a way to monetize tax credits, and people would engage in these tax equity structures, the most common of which was a partnership flip, where a tax equity investor, which is someone with a lot of cash and a lot of tax liability, would become a partner in a partnership that owned the project, and then the rules of subchapter K and the partnership tax rules in the code would be applied to allocate the credit to that partner. These are fairly complicated deals, especially when compared to a credit transfer. Because the investor is not just buying a tax credit, they're becoming an owner of the project. So it's an entire another level of diligence that needs to be done. There's quite a bit more complexity, and costs and time to complete the project typically are more than they are with just a credit transfer, which is just buying a credit from a third party for cash. The terminology here is that it allows eligible taxpayers, which are our sellers, to transfer all or a portion of a credit to a transferee taxpayer, which are our buyers. The eligible taxpayer, the seller, makes the actual election to transfer the credit. And when they make that election, the transferee taxpayer is treated as the taxpayer with respect to the credit. So they can use it to offset against their tax liability. If the seller is a partnership or an S corporation, important to note that that partnership or S corporation has to make the election to do the transfer. You can't have a situation where you've got a partnership and two partners, for say, one can use the credit, one can't, and then the one who can't decides to transfer their piece of it. You need that decision to be made down at the partnership level. And these elections are made by the eligible taxpayer, by the seller, on the return for the year in which the credit was determined. These are the eligible credits that are eligible to be transferred. The ones that are probably most commonly transacted on in the marketplace are 45, 48, the ITCs and the PTCs, and the Advanced Manufacturing Production Credit, 45X, although certainly any of these could be transferred if the deal makes sense. The credits are determined and transferred year by year and project by project. So if you have a group of projects, say solar fields that were all placed in service in a year, whichever of those are considered one project under the tax law, you can transfer those for that year to a buyer, and that's how the sort of how they get broken down between years and between projects. One thing to note is that if you are looking at a wind farm, each tower is its own facility, so each tower technically has to have its own registration number and does makes its own election to transfer the credit. One very important thing to note is that credits can be transferred once. So brokers, there are many brokers in the marketplace, and they can be very helpful matching up buyers and sellers. But that's all they can do. They can match up buyers and sellers. They can't buy for their own account and then try to resell to someone else at a profit. The transferee taxpayer, the buyer, takes the credit into account in the first year that ends with or after the year of the seller where the credit is determined. So if both buyer and seller are calendar year taxpayers, it's rather easy. But if one has a different year, you just have to kind of see where the end of the seller's year falls, and then that's the year that the buyer takes it into And also something people are curious about often is that when you do one of these deals and close it, you can begin taking that credit into account for purposes of your estimated tax payments, even if it happens in the middle of the year. The eligible taxpayers that are eligible to make one of these elections is any taxpayer that's not on this list. So these are tax-exempt organizations, governments, tribes, Alaskan Native corporations, and rural electric co-ops. So tax-exempt organizations and governments and other government-type entities. The reason that they are not eligible to make a transfer is because these are the taxpayers who are eligible to take direct pay on any of the credits, most of the credits. Whereas if you're not on this list and you want to use direct pay, it's only hydrogen, carbon capture, or the 45X manufacturing credit, which you're eligible for direct pay. An important note for consideration, what you can pay for one of these credits is that it must be paid in cash. This is rather easy to determine whether or not it's the case in most situations where you have an unrelated buyer and an unrelated seller transacting at arm's length. But if you have a situation where, for example, you are a 45X manufacturer, and you are entering into a transaction with a buyer who's not only buying your credit, but some of the widgets you produce, then you do kind of need to pay attention to make sure, consideration is cash for the credit as opposed to some kind of discount or overpayment for the widget that is also being purchased. Also, the timing is important. To be considered paid in cash, the payment must be made in the period that starts with the year where the credit is determined and ends at the earlier of either the buyer's or seller's tax filing date. So, for example, if you are doing a 2024 credit,